of responsibility on the auditor and the audit firm. Don't be surprised, down the line 5 years, the chartered accountants may become an information specialist because everything is moving towards technology. Any chartered accountant firm without a computer specialist or information specialist, technology specialist, will not be able to carry out an audit. Let me give you a simple example. We have accounting standards. Accounting standards are guiding principles. Accounting standards does not mean that I issue a report based upon whatever I verify. A revenue recognition, take a simple example of a revenue recognition. A revenue recognition requires that there should be a buyer and a seller, there should be an arm's length price, there should be the delivery that should take place, and the transfer of control should happen, and therefore the revenue can be recognized when it is reasonable that the collectability is assured. Take the case of the e-commerce. Take the case of all of those businesses which run on commerce platform, or for instance, Airbnb, or Ola, or Uber. How do you recognize revenue? What are your guiding principles relating to revenue recognition? We still go and fall back on the same revenue recognition standards? The answer is yes. But do we understand the business model? If we understand the business model, accounting standards are only guiding principles. Therefore, it brings back the question to all of us, do we understand client's business? Somebody might say, our responsibility is only financial statements. Why should I understand the business? My understanding of the business is only to the extent of interpretation of an accounting standard. Now, for instance, I have to know if for an oil and exploration gas company, when do I capitalize that expenditure? When the well is successful, or when you expect that near to successful, or you might say it might take a couple of years before you really find a well. When do you capitalize it? You need to have some technical expert who should support you. He should explain to you as to at what point in time you will have oil in the well and when will you capitalize it. Till such time, you will not be able to just apply the principles of expenditure incurred, and therefore it says in the process of construction, and therefore you keep on capitalizing it. So therefore, what brings back to us as professionals is our main issue, I would say the main weapon that we use or issue at the end of an audit is an auditor's report. If I really were to ask you what is there in the auditor's report, you might say there's an opinion paragraph, there's a basis of opinion paragraph, there's an auditor's responsibility, management responsibilities, and a host of things that we need to comment upon. If we start applying each of that, what we write in an auditor's report, and if we read it carefully, we comment on fraud. We comment on misstatement due to fraud or error. Now the question is, if we have to comment on misstatement, that means our audit procedures should determine whether these financial statements are free from any material misstatement due to fraud or an error. When you say fraud and error, then you might say, sir, ours is only a true and fair view. Ours is not a true and correct view. But today the regulator says it is the responsibility of the audit and the auditor and the audit firm to report on fraud. Take an example. If you need to commission something or you need to get a license, you need to go and attend to any of the income tax or any of the regulators or an RSC. there is a certain amount of payments that are made. It is made because you are an auditor who is principled, will say, sir, I don't want any bribes in your financial statements. I do not know how you will manage. There are agents who will manage this, you pay them, but your transaction should be through check or through RTGS. So you say, I have told my client that every transaction should be above board, that this transaction should be with a contract. I verify the contract is valid. But the payment for which it is intended to pay is to pay bribe payments. Now the question then is, you as an auditor absolve yourself saying that there was no fraud? Because this is not only on the company, it's also by the company. If you make any payment, right, you need to get your work done. Somebody might say, sir, payments made to government officials does not fall under the category of fraud. Then what does fall under the category of fraud? So the question now is coming back to all of us that no longer you can say we are only a watchdog, we are not a bloodhound, and some past president says we should be barking dog at least. The question is, our profession does not say we are dogs. Our profession says that we are competent enough to issue an audit report. There is a fundamental challenge that each one of us face because we do not validate the propriety of a transaction. We only audit we only audit to get a reasonable assurance that the financial statements give a true and fair view. We do not verify from a proprietary perspective. What does that mean? That means we don't go back and check that every transaction which has been entered are valid in the eyes of law, can be validated in forms of any transactions which you can corroborate. That means if I send out a confirmations, if I can check in any other income tax or GST or any other portal where I can validate it, that the transactions are valid. Now the question is, when we do not do proprietary audit, how do we validate what is called as a fraud? How do I determine it's a fraud or not? So the fraud has become a big issue, not only in India, across globe. And it is here to stay. Someone sneezes in UK, someone sneezes in US, someone sneezes elsewhere. Our regulators wake up and say the auditors are not carrying out audit procedures in accordance. And that's the reason party transactions, we talked about what is called a company, it's relative under the definition of Companies Act, related party transaction under the accounting standards, that is getting broadened even in the auditor's report. That means, in other words, every transaction that is entered by the listed company or the unlisted company or by the subsidiary of the listed company, in which listed company is not a party, those transactions has to be validated if it meets the threshold of a consolidated turnover. It was 20%, from 2023 it becomes 10%. That means every transaction that has been entered has to be validated. Now, that is for 23. But in 21, in the auditor's report, you need to verify, validate every funds that have been lent by the company to subsidiaries and its end use. In other words, our audit procedures from an examination is moving to verification. Examination is of a records, verification is of a transaction, and the end use comes under the verifications. So it falls between a true and fair view and a true and correct. A true and fair view is basically taking a sample, a population, checking through a materiality, arriving at a procedures. Verification is going through the entire spectrum of transactions, validating those transactions and commenting upon it. And if you see the new auditor's report, and the CARO, you cannot complete. It can be only reversed through journal entry, an additional entry that gets posted. So therefore, Tally, QuickBooks, and all of those will no longer be falling under the category of audit trail. So the audit trail becomes very, very important for all of us. Given this, it's time for us to introspect. We need to start looking at us and say, are we doing the same way that we have been doing for long, or are we changing our methodologies? Are we looking at information which is outside of the company, in which industry informations are available? For instance, if the company has given you a set of books of records and a turnover and sort of an expenditure or a profitability, let's take a simple example. Take a Lulu supermarket, because they are the people who sponsored. Take in their case. If they say my revenue and my gross margin is this percentage, so many outlets we have, this is the area per square foot that we make sales. This is my area per square foot that I have expenses. This is my area per square foot for which I need infrastructure, and this is my cost and this is my margin. If I'm auditing something which is equivalent or similar to Lulu supermarket, I should be able to measure it using those matrices. I cannot just be taking the information that is given and produced by the entity, validate and issue an audit report. I need to do beyond it. Suppose if I say square foot, if I say if the footfall in a particular market, in a particular area is higher, I should know the number of residents who are living in that particular place to say that the sales which they are showing is appropriate or valid. This is the change that we need to start looking at as an auditor, not relying on the information which is provided. That means I need to have corroborative evidences. I need to have evidences that can support which can support an analysis per point of sale, number of sale, working hours, product movement, inventory movement, the price at which number of times. I should be in a position to validate. Only then it becomes an audit evidence, and therefore the issue of frauds gets discussed there. Take the case of pilferage. Some companies in a retail might show 2%, some might say 1.6%, somebody might say 4%. Again categorized. High value item, the percentage could be higher, but the volume could be lower. Whereas in a lower volume, the percentage of pilferage could be higher, but the value could be lower. I need to understand the business. Only when I understand the business, I will be in a better position to do an audit. If I don't understand the business, if I don't understand the matrices, I will not be in a position to validate this. Take a simple example. If you take the hotel occupancy, right? One way of hotel occupancy that so many people are occupied, so many guests have come, right, is through what is called as how many rooms booked, what are the room rate, and all of the arrived at it. The other way around to validate is to see how much of service that has been done by the housekeeping. How many towels changed? How many napkins changed? How many soaps and everything changed? If you make an analysis of that and then compare with the number of people who have occupied it, that is one way of looking at an analysis. Somebody might say, this looks stupid, but let me tell you one thing. Today, the audit is not evidencing through what information the company provides. Audit is corroborating through your audit process what will give me a same conclusion if you validate this. Or for instance, the number of air conditions during the period. If a particular floor is not occupied, you may shut down the air conditioning in that period, or you may cut off that expenditure. So these are some of the analysis which we should do as an auditor to corroborate. Take the case of a building material, the cement industry. Cement industry, if you need to understand, the biggest cost factor is freight. other than the normal raw material, all of that, limestone and all of that. If I have a unit in, let's say, in Cochin, and if I have to send it to, let's say, in Chennai, the cost of primary freight could be very, very high. And that's the reason, and also the limestone may not be available. So therefore, many companies where there are natural resources which are available, like the limestone, that's where majority of the factories will be located. But where do they supply? They don't supply from north to south or north to east. They supply within a spectrum of the area in which they operate. So that's how the cement industry works. And how does the prices work? It can run through a cartel. It can also run through what is called the weather conditions. Certain states can have very, very wet weathers. Certain states can have dry weathers. Certain states where they would have undertaken projects, capital projects. So we need to understand not only what the company does, surrounding what it happens, basis on which you will validate what is the sales, what is the selling price, what is the quantity. Therefore, you should start benchmarking the company in which you audit to the other companies within the same industry and look at the matrices. Only when you start looking at the matrices, the capacity utilizations, the people, the price, the gross margins, the net profit margins, only from borrowed funds or share premium or any other source by the company to or in any other person or entities, including foreign entities, with an understanding whether recorded in writing or otherwise, that intermediary shall, whether directly or indirectly, lend or invest in other persons or entities, identify in any manner whatsoever or on behalf of the company or provide any guarantees on behalf of ultimate. That means, in other words, the funds that has been drawn by the company or loaned to that subsidiary should be for that purpose for which it is drawn. It cannot be used for any other purposes which can be in the nature of the related party transactions. Let me share with you a recent example. One of the companies started sending funds to its subsidiary. Now, the subsidiary was its initial stage of setting up, because if you have to raise and send funds through an authorized dealer, it goes through the loan and all the ODS certificates is required. So the company said, I will advance money to the subsidiary. So they advanced money to the subsidiary. When they advance money to the subsidiary, it is for the purchase of a material. And that material should come back within a period of 365 days. The subsidiary was in the construction phase. It was not generating any revenue. Once the construction phase was over, the banker said, you now raise an ODI, you can raise an ODI and get the advances repaid. Because it had to fall under the ECB route, because it had to follow all the regulations, the company went into an alternative route of sending the money through as an advance. Now, if I have to report as an auditor, was this for the purposes for which, what was it sent? It was for purchase of material. Has the material been received? The answer is no. Has the advances been returned within the period? The answer is no. But the company again sent out a money through an ECB loan, and the money was collected back, was refunded back to the parent company. Now, this is what is called as rerouting of money. And this would require reporting. That is the reason why it is very important that every transaction that has been sent between the parent company and its subsidiaries, any beneficiaries, could be joint venture, associate, and all of that, the end use of money has to be validated. Take another case. Whether the management has represented to the best of its knowledge that, as disclosed in the note, no funds have been received by the company from any persons. It is both given as well as taken. Based on such audit procedure, the auditor has considered reasonable and appropriate in the company. Nothing has come to the attention that has caused contained any material misstatement, representations not alone, validations becomes important. So from an examination of books and records, now you're moving to verification of transactions. Take another case, F, whether the company in respect of financial years commencing on or after 1st of April 22 has used such accounting software for maintaining books of accounts, which is a feature of accounting audit trail, facility and same have been operated throughout the year, all the transactions required in the audit trail features have not been tampered with. First of all, if we are doing the bookkeeping, we need to first educate the client, this is what is required. Somebody might say, we'll go back to manual system. Then everything is recorded in the manual record, so therefore there is no problem. But the point is, if the company was already in a software, it can't go back. You could be questioned by the management, by the regulators, saying that why did the management change from a software to a manual? So this becomes a very, very important aspect of it, because it not only impacts your reporting under the financial statements, it also impacts internal financial control reporting. Next, this is where the regulators are coming after the auditor. Now, the regulator believes if there is any fraud that happens, any issue, that the auditor is involved. Small, big, there's no distinction. But the question then is, should we now change our audit procedure? If we have to change our audit procedures, don't do materiality, don't do sampling. Go and look at the substance of the transactions, look at the proprietary of the transaction and comment whether there is a fraud that has happened. Now, how do you identify a fraud? There are ways how you could validate it. I'll give you one simple instance. If you have got a GST or a PAN number or any other number that you have, if you have a transaction entered with that company, and you find that significant transactions happens only with the company during the year, do a download of their financial statements. If it is a private company, download of that. If it's a partnership company, ask them to present their financial statements. Or do a validation through their PAN numbers or any other numbers, GST numbers, to see whether the transaction is valid or not. It so happened, one of the companies incorporated another entity. Premises was the same. It was only differentiated by a compound wall. They put a name board the other side under the GST. Now this only transaction which happens is only with this entity. And who does? It is done by the company itself. It's only a Benami company name which has been given. So when one of our associates went and validated that to just go and see whether this facility is really available or not, he was taken around for about 10 kilometers and brought back to the same compound. The boy, being smart, he just took the photographs, what he entered before, what he entered later, and then came back and said, the company does not exist. While it is possible where you can influence your client to reverse the entire transactions, just think through it. If we have not changed an audit procedure, and if the boy, the associate, was not smart enough, sorry, let me just take some water. If the associate was not smart enough, this issue of whether this revenue doubling would have been prevented or not. So the question then comes up is, for any transactions which are substantial, apart from validating the vouchers or transactions or agreements, go and do a physical verification of those particular, inspect those entities, just to see whether the transaction is valid or not. So somebody might come back and say, sir, it is not possible. We cannot go because they will not permit. It's a security. They can't do it. But just imagine, 20% of the transactions comes from that entity. Are you saying that the company will not be able to influence the other company? I think these are some of the procedures that we need to start re-looking at it. Start looking at each of these differently from a transaction which we validate. And that brings back our responsibility that fraud is an identified risk of material misstatement. No longer we can go back and say we are not responsible for fraud. We will be held responsible for any fraud which will happen hereafter. And more cases will come through it as more and more automation happens at the government side. Government is completely, today you might say that income tax side is not failing because the info is not done properly, therefore there's a problem. No. They've connected the servers of SEBI, they've connected the servers of GST, they've connected the servers of every other tax, information from banks, post offices. How do you get pre-populated information? They've connected to the servers. Transaction will not escape. There can still be transaction in cash, but even that will diminish as we go along for a long period of time. But let's think through it. To say fraud is not our responsibility is no longer valid for all of us. Somebody might argue saying that it's not our responsibility, but that's not what the government thinks. Government thinks that we are responsible. And therefore, fraud is an inherent aspect of our verification. And that is something which we need to start looking at it. I've already spoken about audit is just a backward looking, undue public criticism which is there, misconception auditor is responsible for uncovering frauds. These are all what is expectation gap. But the fact remains, we might say that society does not understand auditor. Society does not understand auditor. Does the auditors understand auditors? Just think through this aspect of it. Because the society believes that auditor should identify it. Lack of trust. There is a lack of public trust which happens. Anywhere or anything which happens, they say auditor is responsible. Could be a financial statements audit, could be a GST audit, could be a tax audit, could be any audit. Somewhere there is a revenue leakage, somewhere there is GST, somebody has been slapped, auditor's names up, chartered accountant names appear. Today you remove auditor and put it, chartered accountant's names appear. Now take the case of the bill, the new bill which is put it in the parliament, which says a non-CA is going to look after disciplinary cases. Now it is a bill, once it is passed, it is approved. It might go to parliamentary panel, but it will still come back saying that still the authority will remain with the government. So when the mechanisms are all moved, and the greatest example is, we have taken the disciplinary mechanism even more than 10 or 15 years, even the people are not there or retired or died, whatever, it's still the cases are not settled. Now they're talking about within 365 days. As this bill becomes a law, everything, now who is responsible? Now the biggest challenge there is not about, somebody reporting to somebody. Anyone and everyone can report. Let me give you a recent example. Two shareholders fought and put a blame saying the financial statement is not true and fair view. They sent a disciplinary notice to ICAI. This is a real case. And the ICAI started examining, the disputes, shareholders' disputes, and called for the auditor. There was a settlement between the shareholders. They said, we want to withdraw this complaint. Just look at the mockery at the expense of a chartered accountant who has signed the accounts. Two promoters fighting, and two promoters fighting are very common these days. You have an Indian promoter, you have some investment comes, the investment guy comes, everything is fraud, he will file a case and go to MCA, he will go to ED, he will go to everywhere. And who is now in all of this? Auditor, the chartered accountant. When you have this extent, when you have this new bill which is coming up, what is dangerous in that is, any person can complain. Once you complain, you can't withdraw. That means, I don't like your face one day, I go and complain there is a fraud on you. You have committed a fraud. The onus is on the auditor or the audit firm to prove that there was no fraud. Not for the guy who said there is a fraud or not. He's not bothered. This is the extent what the bill is going to do damage. And that is the reason why this disciplinary mechanism is something, and this bill, if it becomes a law, that's where it looks like, if it becomes a law, it becomes a challenge. Auditors not meeting society's expectations. Somebody asked me in an annual general meeting saying that, sir, financial statement kaisa lag raha hai, sir? Financial statements and share market has got no relationship. If you believe that a financial statements have got relationship in a stock market, a company which is still not in operations is prices which is face value of 10 rupees is quoting at 2,000 rupees. Has it got any relationship? It's got no relationship. But when it comes to approval of the accounts, they have a right to raise a comment saying that because of you I've invested, because of you I've invested. This is the extent of proxy advising, the proxy advisors. There are a set of proxy advisors who sit and says, these financial statements do not give a true and fair view. That's the reason if you see, in the last AGM, if you have seen a lot of the news reports, many of the remunerations of the managing directors was thrown out by the shareholders, with SEBI tightening much more on what is called as related party transactions, which actually should have been there from 2013 Companies Act, which got diluted in the Companies Act because of the corporate, now being brought back by SEBI in the form of a related party transactions. And for any related party transaction exceeding 10% of the standalone or overall consolidated percent of 100 crores, whichever is lower, will have to have the approval of the shareholders, excluding this related party transaction who are interested. Now you're bringing back this law, again this law will go back. The question then is, should somebody not come back and say, listen, keep all this related party transaction validated and approved by the board of members for the end use? Issue is resolved, right? Who is responsible? Corporate, the management. Who is approving it? Board of directors. Why should you make auditors saying that whether this is end use has been appropriately done or not? If you see SA 600, SA 600 says that if you cannot audit the books or you cannot call for the books of the component auditors, that means you say, I only am the auditor of the parent company, the subsidiary company auditors, I cannot go and ask for his files and records. Whereas under the Companies Act, it says every subsidiary financials which is substantial should be audited or reviewed by the parent company. Auditing standards does not permit. Now just look at this dilemma. You cannot go and validate from the statutory auditor of that entity component, but you have to comment on the end use of the funds. How will you comment on the end use of the funds without relying on validating or checking with the component auditor? SA 600 does not permit you. Companies Acts permit you. I think this becomes a big challenge because you would be component in some cases, you will be the auditor of the parent company in some cases. How will you deal with this? And this has to be reported now as of 31st of March 2022. And therefore, not only this, if you're auditing subsidiary of listed company, a new change has come. Earlier, it was only limited review of standalone. Now it says limited review of the consolidated financial statement also. That means every component auditor also has to issue a last quarter report, review reports. Now, when you have so many changes which are happening, if we miss out a single thing, in our opinion, or in collecting this information, the parent auditor is held responsible. So therefore, if you were to look at today, if you look at as an audit firm or an auditor, it is not the changes which are coming in Companies Act, it's not the changes which are coming in SEBI, not the changes which are coming up issued by MCA, but every changes that are coming out by every regulator, whether if you're doing bank, by the RBI, if you're doing by IRDA, by the insurance companies, by IRDA. If it's by listed companies, all those regulators. To this extent, what this information has come through. I don't know how many people have seen the report of NFRA on, see, NFRA is not only in the auditor, NFRA is also on the companies. So you may have reports, so let's say you're auditing, let's say BHEL, you're an auditor of a BHEL. NFRA has not selected you for its review, but NFRA has selected BHEL for its review. If NFRA has selected BHEL for its review and comes back saying that this is not in compliance, the effect on you as an auditor that this is not in compliance with the accounting standards, the management says yes, 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 because they have the CAG process. What will you do as an auditor? It's a live case. There are KIOCL, which is a company where the NFRA has issued a report. If you want, go and see in the NFRA website. Where they've given saying that this accounting policy is not aligned, this is accounting standard is not done, this presentation is not correct, this is not correct, this is not correct. What happens to the audit and auditor? And I'm telling you, this is only going to go up and up and up and up in the coming years, because NFRA is divided between listed and those public interest entities with borrowings and private unlisted companies, and with the QRB. QRB is now coming up heavily on private limited companies. And that has got a plan of, if you have got a larger practice, up to 3 years once. If you have got a partners up to 20, it's about 4 years, once in 4 years. If it is up to 10, it's once in 5 years. That means every audit firm will be covered by the QRB in the next 5 years. Now, each one of them issues a report. And when they issue a report, they publish the report in their QRB website. That means, so far you had a challenge only with the listed companies, with larger bodies. Now you have got another set of people who are going to examine it. In all of this, government is saying ICAI is not doing, ICAI might come back with something else and say, I want you to do this also. As it is, we have a QRB for tax audits. Now look at it, where is this audit profession going? Is this over-regulated only on the audit and audit firms? Now, what are we trying to achieve it? So therefore, that's the reason I'm saying 5 years down the line, I may not be talking on auditor and audit firm, but I may be talking about audit and digitization and how it will improve. Because today it's going to be a blockchain technology. I don't need balancing ledgers. I don't need. Everything is connected. Why do I need an auditor? I have real-time information. So audit is going to move from historical to real-time audits. A real-time audits is something which is introduced by, if you have audited any NDDB companies, every voucher has to be signed before it is entered. It's called pre-audit. They have a pre-audit. Somebody has to audit the transactions. After that, there's an internal audit. After that, there's a statutory audit. So it will be a real-time audit is what is going to be there from an historical audit. And that is a change that will be brought in. Given taking a project through a project report versus actual working of this, if the difference results into any diversion of funds, that is considered as fraud. And that statement should be brought into this financial statements. And that is the reason why, and who brings this? All these advices are given by the bankers, by the ROCs and all of them. And who provides this information? ROCs employs all these accountants as consultants and all of this. They give whatever they want, and that is issued, given to the panels and all that, based on which this, what is called as the documents which gets released, or a white paper which gets released. And I'm telling you why this is very important. Whether it is taxation services, whether it is audit services, today we have to be superior than what right now it's happening. We cannot be at this level of only doing attest functions. We have to move to what is called forensic thought process. We have to move to what is called information technologies. The digital world is what will take us to the next level. We have to invest. Because I'm a firm believer, today we have to survive as a profession. Audit of books of accounts will not be the basis. The basis would be specializations, and that is what will drive us. Let me talk about quality, right? Quality is not what we believe we give. We cannot say we are partners in building. We can't make a statement saying that we are the people who have, increased the number of tax filing from 4.9 crores to almost like 5.96 crores by 31st of December. Everybody was making that statement. One way you say we are partners in national building. Other way around, we keep on sending it on Twitter saying that, Nirmala Sitharaman in a different way. The third way around, you still claim that we have burned this midnight oil and that's where it is. The fact is what is important. Our audit quality is not determined by what we do, it's what is received by the person. Sure crisis of trust. This crisis of trust is not now, will be there throughout, because somewhere there is some fraud will happen. Now today we have started talking about cryptocurrency. Indian currency itself we are not able to understand, now we have started with cryptocurrency. Tomorrow's world is going to be cryptocurrency, similar to what you understand derivatives. As much as we have knowledge on derivatives, cryptocurrency also will have the same way. Now, there is a case, recently there was a case, there was an incident of where one person who did transaction in cryptocurrency paid a penalty of 49 crores. Very recently. Just imagine, the world is completely moved to cryptocurrency. There is exchanges, there are losses which happens. Nobody understands it. But that is what is going to be the future. So invest in the future. Learn new things, new skills. That will what make us much more better as a professional. Effectiveness of audit. I think applying auditing standards, applying audit checklists is not going to help. We need to bring in data analytics. Data analytics is the new thing which will happen. Let me share an instance. How do you identify a fraud or scheming of things in a watch company, right? So you have a watch retailer. The retailer, the company comes up with various schemes that if you buy this from this date, so let's say we are on Republic Day, let's say Republic Day is coming. Anyone who comes on from 26th to 30th, we have Republic offer, we'll give you 20% off on watches. And this was released on 24th. I bought the watch on 23rd. Now, I call up the shopkeeper, I said, now this discount has come, what do I do? Because it gives me about 25% of discount. He says, no problem, you come to me, I will say you have returned it, I'll make the voucher change, and based on the vouchers, I'll say this is returned and you bought back again. Now what has happened here? Here is a case where a goods can be returned within 7 days, so he came within 7 days. It's a valid transaction. The second thing is, because the prices have gone down, he said he has purchased another watch. All they did was change the transaction only. The watch remained with him. One was a return, other was a new billing. And because of which this person got this idea, the salesman, started calling up all the customers. Sir, I'm calling up to check and validate your OTP code you've recently purchased. And there'll be OTP code which will come on. And at each OTP went on changing, reversing all this old and taking the discount. Just imagine. When you do a normal transaction, what you do an analysis, okay, 26 from 24 it was this, 26 applied, and therefore the discounts given is appropriate. 24 return of sales, you accounted for all the transaction, return of sales was appropriate. But what was not validated was who changed it? Who changed it? What time it was changed? So there was only one person who was sitting in the night saying that he is clearing all this. Between 11 and 12, he cleared everything. This ordinarily you can't apply through vouchers. You can only apply through if you have technology. Start applying technology. How many transactions happened between 10 hours to 15 hours? How many transactions happened between 6 p.m. to 9 p.m.? How many transactions happened between 10 p.m. to 12 p.m.? If you can get the maximum transactions, what happened, and you see the reversal, you have a trend, and that trend would detect a fraud. I'm saying the extent of technology will play a major role in tomorrow's world. And that is what is effectiveness. I'm not touching about perception about audit quality because you would have talked about. But let me talk about how do we bridge this gap. What are very important? Exploiting the digital. I'm a great fan of digital because digital is here going to stay. We have to invest, whether we like it or not. Integrity. Now, it's a recent case. One of the chartered account firms came back and said, sir, there is one company who is willing to give me the audit. The fees is 2.5 lakhs. But he has not appointed me this year. But he's willing to take me, but I will not sign, but the other auditor would sign. Should I accept the audit? Instance of where you're not legally appointed by the members in the AGM. There is a dispute between the promoter and the old chartered account firm, and therefore he did not pay the fees. Now this chartered account firm wants to do that audit because he's his friend. The question then is, he's finding us ways and means to see how do I do that, how do I get that business of 2.5 lakhs? Integrity plays a major role because we are leaving trails. Today, resignation of auditor and audit firms are being tracked by the ROC as well as by the ICAI. Earlier, it was only ROC which used to do it. Now it is both ROC and ICAI. And the ICAI, to the ICAI should say whether any financial statements that have issued are unmodified or modified. That means if you've got qualifications, then this new incoming auditor cannot accept a financial statements, cannot accept that audit without going through each of these qualifications. So therefore, do not accept audit after the AGM is over. Do not accept audit after 31st of March. Because if you accept any audit after 31st of March, your year-end procedures, your cut-off procedures, your physical verification, everything will go for a toss. And don't accept audit on 30th of September and issue an audit report because of our tax audit purposes. Integrity, independence is of immense importance for each of the chartered accountants. Audit quality, the less we talk, the better, because our work should speak what we do, and communications. Mindset, skill set, and tool set. And I'm telling you, tools, visualizations, blockchain, robotics, the robots, bots, you'll find how easy it is to get information on your desktop. You don't have to navigate. You just have to use your algorithms. You have to use what is the report, end report you want to have. That report will provide you all of these informations. And I'm telling you, that's the greatest investment anyone can do as far as technology is concerned. We have to be literate in information technology space. Not getting a DSA, CISA degree, no. All you need to have understanding of technology. Sit with each of the technology specialists to go through this process. Understand what it comes out. And that is what will change it out. The ERPs, the performance managed EPMs and digital, this is the future. And this is how each of the reports will be viewed. So therefore, we need to address the perception, willingness to accept present, introspect, identify root causes, identification of possible actions, willingness to transform. How much are we willing to transform? Falls the essence of it. I'm not getting into this audit of future, but let me talk about this SEBI part, which is going to be very, very important. It will fall in place for private companies going forward, but let me talk to you about the related parties specifically they brought in. So there's an amendment which has been brought in by SEBI in respect of all of these related party transactions. Now what they brought in is the 20% threshold. Now they're broken down between 20% and 10%. 10% is effective 1st of April 2023. Earlier, any person or entity belonging to promoter group of a listed holding 20% or more in the listing shall be deemed to be a related party. That was the definitions. Now, any person or entity forming a part of the promoter of the listed company, or any person or any entity. So the promoter is, in addition to promoter, any person or any entity holding equity shares of 20% or more or 10% in the listed either directly or on a beneficial interest basis. Now the beneficial interest basis is under section 89 of the Companies Act, and that is far reaching. You may not directly hold 10%, but there's the ultimate holding company which is there, which is an investment company where that person holds 10%, who is nowhere related in company A, company B, company C, but A, B and C put together in company D holds all of this. In that company, if there is anybody who holds 10%, that person will be considered as a related party transactions. Related party transaction is not what is defined under Companies Act, not on the accounting standard, but the beneficial interest. This is the definition of a related party. Beneficial interest under section 89 is far stretched beyond whatever maps that we give through or whatever schedules we give through. Next, related party transactions apart from the listed companies or any subsidiaries on one hand, and a related party of transaction listed or any of its subsidiaries, in addition, the purpose and the effect of which is to benefit to a related party. That means, apart from your parent company, subsidiaries and all of that, if there is any other party who's benefited because of these transactions, even those people should be included under related party transactions. Next, there's a threshold that has been defined. Earlier, the threshold was 10% of annual consolidated transactions. Now, if the transaction to be entered individually or taken together with the previous transactions, not only current transaction, with the previous transaction during the year, exceeds 1,000 crores or 10% of annual consolidated turnover, whichever is lower. Earlier, it was only 10% of annual consolidated turnover. All related party transaction and subsequent material modifications shall require prior approval of audit committee. This is subsequent material modification. There is original transaction approval, there is subsequent material modification transactions required. And this has to be defined by the audit committee. So what is important for listed companies is prior approval of audit committee is one. Effective April 1st, 2023, there's a change in the transaction, how we calculate the related party transactions, which talks about 10% of annual standalone turnover, earlier consolidated turnover. Prior approval is what is required. Earlier it was shall submit within 30 days from half year for disclosures. Now shall make within 15 days from the date of publication and make disclosures of both standalone and consolidated financial statements going forward every 6 months. Now in the IPO, there is also, if you suppose you are involved in an IPO, let's say if you are in an IPO. Now what has happened in an IPO, earlier, if you are the auditor of the current audit, you will only audit the current period. The earlier period auditor would be done by the comfort letter would be given by the previous auditor. Now with the revised change, the existing auditors is not only are supposed to audit now, but also the other period also. So in other words, what happens is, the earlier comfort used to be given by the earlier auditor. Now with this change, you will be responsible to audit not only this, but also the other restated financial statements. So therefore, whenever you're accepting an IPO assignment, make sure it is not only with the current period, but also you have to start giving the comfort for the earlier restated period. And this becomes, and the SEBI still not come through with this process, but this is something which is expected to change. There will be resistance because if you have to go back and audit the last 3 years in which you were not auditor, how will you validate inventory, how will you validate returns, how will you validate payables, how will you do all of this? Today's SEBI's executive director has he says, I have taken a decision. Now you have to work around. But just think through this. It is easier if I am not the auditor, if the auditor of the past has already issued. How can I issue to go back for the last 3 years? I think that is something which becomes a very, very important aspect. And the other important thing is every audit firm should be peer reviewed. If it is not peer reviewed, you cannot be involved in the IPO activity. And this is another aspect that has been required. For every component that's to be audited, you need to have the peer review. Now for a peer review, if there are material components, only those firms which are peer reviewed only can do the audit, not every other person. Now, another change that is very important which has come up is CARO, and I want you to focus on CARO. Let me tell you one thing, 47 clauses, and each of these clauses are exhaustive and requires a lot of efforts by the audit and the audit team, auditor and the audit team. Now, if you were to look at the clauses, even though it is 21, total comes to 47. Everywhere they have now started looking at, for instance, take the case of a bank. If you have got any banking transactions where the loan sanctioned up to, let's say, up to 5 crores, it does not talk about drawn. I am sanctioned 5 crores, I have only drawn 1 crore. The stock statements have to be verified. Whatever information that is given to the bank on a quarterly basis have to be verified with the books and records. You've given stocks, you've given receivables, you've given payables, you've given advances, you've given various things. That has to be audited and reported by the statutory auditor. Listed companies I can understand because you do quarterly closing. How will you validate for private limited companies? How will you validate for those companies which does not close books on a quarterly basis but closes books on an annual basis? Please don't take this easy because we are responsible, because in the CARO we have to say this quarterly stock statement submitted or quarterly financial information submitted to the bank are in agreement with the books and records. You have to validate all of these quarter by quarter. So therefore, just go back to your client, talk to them about it. The second aspect of it, we always had a clause of internal auditor. Whether their company had an internal audit was commensurate to the size and nature of business, and that's all. Today, if there are any significant observations of the internal auditor, the statutory auditor has to consider those observations in his audit procedures. You cannot say, I have seen the report, I have not seen the report, I have not looked at the report, therefore no. It is your responsibility to call for the reports. It's your responsibility to examine the reports. It is your responsibility to identify those issues which are relevant for your purpose of audit. And if it is material, you have to report in your auditor's report. So the internal audit becomes very, very important. The other aspect which has been brought in is the cash flows, the short-term funds used for long-term purposes. Now, this was a clause which was heartbreaking for many times, and therefore it was removed. Now it has been brought back. Many companies which does not have support of long-term funds, they don't have term loans and all of that. Bringing this through this route means that if they've used any of the working capital for long-term purposes, that has to be reported. It has got far-reaching impact. I'll tell you why it has got far-reaching impact. If you look today at the auditor's report, in the auditor's report today we say in the management responsibility column saying that the financial statements have been prepared on a going concern basis. In the revised Schedule 3, there are two components that have been covered. First component, it says, from a solvency ratio perspective, whether this company, whether this entity has the ability or the financial assets to pay the financial liabilities in the next 1 year. Payment for the liabilities which may come up in the next 1 year. That is one aspect. Now you have raised a comment saying that the company's financial statements are not prepared, or the company financial statements are prepared on a going concern basis. But in the solvency ratio, when it comes, the financial assets are not adequate to meet the financial liabilities. Let's say you put that. One way is saying prepared on financial basis. The second is the financial assets are not available to meet the financial liabilities. Why? Because the companies are under losses. Since the company is under huge losses, therefore what happens? You need somebody to support you, therefore you get the comfort letter from there. So you add this issue. Then the other issue in Schedule 3, it says, calculate ratios, solvency ratios, debt equity ratio, net profit ratio, inventory turnover ratio, debt equity, the debtors ratio, all of this. And if there are any variance beyond 25%, if there are any variance beyond 25%, you have to explain the variance. So you have a going concern, which you say the company financial statement may be a going concern. Your financial assets are not in a position to meet the financial liabilities because you got a comfort letter. The solvency ratios are not appropriate. How does your audit report look like? Just a simple, if I have to analyze, if one is negative, the audit report will be negative. And that is the reason true and fair view becomes a much more decisive now. Because you can't say one way the ratios are adverse, another way you say that it gives a true and fair view. This is the extent of understanding which is required in revised Schedule 3 and CARO revised. Because it has got ratios, it got analysis, and all of this has got an impact. Take another case. There is a survey done by the income tax. And based on the survey, you come across saying that, there's an X amount which has been agreed by the company. So they said to buy piece, because they always use the word called buy piece, so I pay so much amount as taxes. And the tax is related to what? Unaccounted income or unexplained expenditure. We have been issuing audit report all these years. Suddenly this unexplained expenditure or unaccounted income comes. Two things which comes in mind. Does the books and records agree? 2, is this an element of fraud? If you have a survey and you go and accept, is that a fraud? The answer is yes. Because you have issued an audit report on the books and records, and suddenly you say, I've got a record which is not recorded. So what happens to my opinion? Nobody has thought through it. The government has said that, you give this. You as an auditor, what will you do? Will you do restatement? Now the revised Schedule 3 talks about restatement. You will go back and restate? When you do a restatement, what happens to your internal financial control reporting that you've issued? It's your IFC which gets impacted. It's your true and fair way position happens. And how do you account for this? Should you resign now because you found out undisclosed, unexplained expenditure or undisclosed income? And I'm telling you, see, it looks very simple when they have issued this, the revised schedule. Nobody has spoken about it. Everyone has accepted, thinking that, it's a CARO hai, theek hai, chalega. Revised schedule, no problem, everything can be done. Does it impact us? And I think if we start probing into each of these aspects, I think this is where, who protects? Big firms will protect big firms. Who protects other firms? And that is the reason why I'm saying disciplinary mechanism, which is there coming up, is going to have far-reaching impact. A banker can complain, a creditor can complain, a shareholder can complain, a person friend can complain, an enemy can complain, anybody can complain. Whether it is valid or not, it's important. So therefore, what is important? We as an auditor, every clauses that we are going through should be in there. Whether it is application of funds, whether it is utilization of funds, whether it's investment in subsidiaries or associates, all of these things which should be very, very important. Next most important aspect of it is on CSR. CSR has undergone change. Earlier CSR was just a norm of 2%. All tax professionals went and said, okay, fine, you can claim under respective section 32 sections. Then came back and said, this CSR should be made disclosed in balance sheet. Then came back, this CSR provision should not be there, should be spent. Then they came back, what is called as deposited. If you don't deposit, if you don't spend, it goes back to government. Today, CSR has undergone change. The NDU certificate, today people used to go and give it to certain foundations. Now you need NDU certification from those foundations. That is the extent of what validation has gone through it. Next most important thing is physical verification of inventory. If there are discrepancies more than 10%, if there are any discrepancies more than 10%, that has to be reported. Means what? In an inventory, I can have raw material, work in progress, finished goods, stores and spares, consumables. In each line item, if there is a variation of 10%, individually, you have to report it. Now, the other challenge which has been, other important thing which has been brought in is any rollovers, or if there are any loans and advances given to any of the any of the parties, which does not have a fixed term, which has been given at a money much lower than what was it could borrow. So now rollovers, interest not received, repayments, delays in repayments, all of these will now form part of the disclosures. And this is a huge subject by itself, and willful default. Let me talk about this willful defaulters. Whether company is declared as willful defaulter by any bank or financial institution or other lender, just take the case. You've got a consortium of bank, you've taken loans from a consortium of bankers. Each of the bankers have given, let's say, 1 crore, 2 crores, 5 crores, it comes to about, let's say, 10 crores. Your principal banker is SBI, and the other banks are small banks. One banker, you did not pay the money, okay, in the consortium. The rest of the 9 bankers said, you are paying on time. One banker said, you are a willful defaulter. How will you know? How will you identify you are whether the company was a willful defaulter or not? You will be able to validate only when you send confirmation and get this information. So your confirmation of balances should now include whether at any point in time this company was declared as a willful defaulter or not. Otherwise, how will you find out? It's not possible. So therefore, this willful defaulter is not only applicable for the entire spectrum of the loan, only for a major consortium, but also if there are any individual banker who supports this, if there are willful defaults, that has to be brought in. And if willful defaulter, what happens? The covenant says it becomes an on-call loan. From a loan which is payable into X period, will become an on-call loan. It becomes an on-call loan, that means your classifications from a long-term becomes a non-current to a current situations. To this extent is what a willful default can happen. Leave all this. Transactions with those companies which have been struck off. Transactions with those companies which have been struck off in ROC. You have to give the entire list of transactions that you had. Somebody may ask, sir, what is this? Is this valid? There are more than 2 lakh companies which have been struck off over a period of last 4 years. And if any of your companies had a transaction with there and you say long outstanding, you need to go back into the ROC website, put this name of the company to see which are the companies which have been struck off and tie it up whether any of the transaction you had. If you had, name, receivables, payables, bank, cash, fixed assets, everything has to be given in detail. Transactions with struck off companies. This is a big shift which I'm just telling you why. This is just the tip of the iceberg, which information which we are going to give to many of the, when we sign this year's balance sheet. Because of the paucity of time, let me just talk about few things on NFRA, because I want to bring on the specific aspect of NFRA, which is, okay. So NFRA did an analysis on general purpose financial statements, okay, it's called a GPFS, right? So they found that 52% of the active companies have filed their financial statements. And there is, even in the case of listed active companies, there is only about 65%. That means 35% of listed companies still not filed. Out of the total companies filing, 99% have reported a net worth of less than 250 crores. You know, we think we are all large companies, so big companies, country has got a lot of listed companies. 99% of companies have got net worth less than 250 crores. Out of which, 97% of financial statements under AS framework. That means these people are not under the Ind AS framework, but they are under the old standards framework. Only 2% or 3% are under Ind AS framework. That means you're talking about 17,750 companies under Ind AS. Just look at a summary. There are about 11 lakhs, 1.14 million companies. Private companies about 1.08. Listed is about 6,900. And unlisted 54,000. And if you see, compared to these companies, there are only about 3,568 companies which are greater than 250 crores. That means greater than 250 crores is coming only about 3,500. This is where the focus of NFRA would be. The balance 599 would be the focus of QRB. In other words, now of these companies, if you make an analysis, 30% of that 5,94,000 have reported nil payments to auditors. 30% of these companies have reported nil. 1,81,000 companies. The estimated standard, in fact, these people arrived at what is the actual cost to arrive at, performing an audit. A below turnover of 50 crores, they said should be in the range of 1.5 lakhs to 8.43 lakhs. I'm asking one simple question. Why is minimum fees not made mandatory? I'm just saying, use this NFRA. NFRA report says average individual, a chartered accountant to perform an audit of less than 50 crores. Turnover less than 50 crores should be anywhere between 1.5 lakhs to 8.43 lakhs. 41% of companies have made payments of less than 25,000 rupees to the auditors. Out of the total number of 5,99,000, 2,09,000, which is about 35%, have reported nil turnover, and 3,67,000 have reported turnover between 0 and 50 crores, 61%. Simple analysis, one shot, no statutory audit required. One single shot, all the audit firms, except the 3,400 or whatever companies, 3,500 companies is what they will focus. Just look at this analysis with our fees only. Out of 44%, around 44% have reported nil indebtedness. That means they don't have any loans. 2.81% have reported indebtedness of 25 crores. That means there are only 2% which talks about it. And of the total MSE, around 76% have reported net worth in the range of 0 to 25, 25% is negative net worth. Now just look at all of these statistics. These are all available based upon filing with MCA or at the ROC or with ROC. Simple analysis, right? Small firms, small term firms, right? Medium terms, average. And if you look at an average, Metro City will charge 106 lakhs. Small towns should charge about 37 lakhs if the turnover is more than 25,000 crores. 106 lakhs for a turnover of 25,000 crores. Again, I'm only trying to say what is important for each one of us. We need to start rethinking. We are all professionals. We have outlived. Let's say television gets repaired. Let's say internet does not come. Let's say your water cooler does not work. Your air conditioner does not work. You have to use an Uber. What's the rate? He will say 4,500, 50% discount, 2,500 is what he will say. This is the rate. When they can charge an hourly rate, why can't we charge based upon the efforts that we are putting? Our signature has got relevance only when we get paid for what we take responsibility. Otherwise, let us not be in this profession where we don't charge anything to the client. We wait till the client comes back next year to pay us. Instead, invest in that energy to bring in the new skills, the change in mindset. And only when we do all of these, I'm telling you, car manufacturer, biggest threat is not his competitor. Car manufacturer, biggest threat is IT. Because in IT, because today you use technologies, right? In your best example is, you use your GPS, right? When you drive. If I hack your GPS, I can take you anywhere.
Subset the observation. How do you define look at, let's say, 447, 448 of the Companies Act, if you look at 406 licenses, what do you construe as fraud? Number two, on whom does the burden of proof lie? And number three, when it comes to fraud, would you look at
transaction itself is valid or not? You see, let's say you're in a hospital, right? Doctors are paid in cash, right? There's a cut which comes as a percentage referral fee to path department, this department. The question is, you are auditing a transaction. Do you call out saying that cash has been paid to the doctor? Do you call out? Do you call out saying that expenses have been incurred on behalf of the promoter? Knowingly, you know that these transactions are not company, these are personal expenses, or these transactions are not valid transactions. So the point what happens is, the regulators believe that you know everything, but you are not calling it out. When something went wrong, At that point in time, they called out and said, so you are, let's say, a tax practitioner. You go to the department. Department says, sir, I agree to you, sir. I don't want to argue on your books. But I'm telling you, sir, this transaction is not valid. What do you do? Sir, please see what we can do, how we can deliver. Right? The intent is what drives fraud. And that is where now the responsibility is. That's the reason you sneeze, somebody sneezes in GST, chartered account name comes up. Somebody sneezes in audit, some corporate failure, auditor's name comes. Somebody sneezes in income tax, auditor's name comes out. Why? Because they believe auditor has knowledge of all these transactions. So the intent, now today they're not talking about transaction, they're saying the intent. That's the reason if you see the 143.12 definition, the intent that there is fraud is likely to happen is also considered as fraud. If you have reasons to believe, they always say reasons to believe. Reasons to believe is saying the transaction is not valid. That 143.12 brings that aspects of it. But the onus is on you to say the reasons to believe is fraud. That's where it is, right? Did I answer your question?
Fraud is very nebulous term. I say this because I'm a lawyer. I'm practicing as a lawyer right now. So, my view is there has to be a definition for the term fraud, because there is a world of a difference between a civil fraud and a criminal fraud. So how can one hold the auditor to be culpable in the absence of a clear definition insofar as what is fraud? And the moment you leave it to the discretion of a person, it loses the character of it being fraud.
I'm very glad that you're talking a lawyer's perspective. Unfortunately, the regulator believes I don't have to give a definition of fraud, but if they have reasons to believe it's a fraud, then it's a fraud which the auditor has not pointed out. You're absolutely right. This is exactly the challenge which is happening with NFRA in the court. That's the reason the case is not getting settled. Because the NFRA believes there's a fraud. So the greatest example I'll give you, when when you prepare any, let's say, impairment, a simple example is on impairment, right? I'll explain to you impairment. The accounting standard says that if you have generating positive cash flows, and this cash flows will make sure that the value in use or the fair value, whichever is higher, is much greater than the carrying value, then there is no impairment. So I give an opinion on 31st of March 2020 that there is no impairment. Come 31st March 2021, now the government says that knowingly you have not disclosed this as a loss, therefore there is a fraud. This is the difference between being a lawyer and a chartered accountant and a regulator. Regulator says there is a fraud. Chartered accountant says there is no fraud. Then he goes to the lawyer to prove that there is no fraud. That's where the definition comes from you. Thank you very much. That's how it comes up. So to define fraud, that's where we come to the lawyers. So that's where the lawyers play a major role in that. But there is, to be very honest, you cannot define law. It's only the act which you need to prove whether there is a fraud or not. But let's be very honest. And in this, who are present today, let's be honest. Getting a school admission for your own child in a school, tell me, do you bribe that person to get it? In a good college, do you get it? To get your property registered, do you do it? If you say no, we are all honest people, you are living in a very good paradise place. Otherwise, you are living in a normal city like us. All right? Thank you, ladies and gentlemen.
Dear all, before we wind up for the day, may I take the good opportunity to invite the chairman of the Professional Development Committee, our very own Central Council member, Babu Bram Kallivel sir, for a winding up remark, please. Babu sir. Babu sir.
Distinguished speaker of this concluding session. So, Balakrishnan, in fact, he called me yesterday morning, said his son is not keeping well, I may not be able to come. Whether we can do it virtually. I said, let us see how. I'll also pray so that your son should be all right. And by around 10 o'clock, he called me, and basic increase in the audit of public sector undertakings, they are quite convinced. In fact, we are also collating the data to make a comparison what is a fee prevalent in the public sector undertakings and the fee in the private sector. But I am very glad to share with you that the Deputy CAG Vishwanathan ji is very, very receptive to our suggestions, because he is also on deputation as a Director of Finance in a leading public sector undertaking. Therefore, he knows the working. Therefore, this month we are planning to have a meeting with all CAGs across the country with the Controller and Auditor General of India. Therefore, these are all some initiatives which we could do during this year. But we will also try to continuously build relationship. Yesterday was a wonderful day for us. The Honorable Vice President of India came all the way to lay the foundation stone. I am sure this will be a permanent monument for the Ernakulam branch. It's a great honor. At the branch level, the Vice President of India has done the foundation stone. Probably very few branches, or I don't know whether any branch has got this rare privilege. And we had excellent feedback even from the Vice President of India's office on the seamless conduct of this foundation stone laying ceremony. And I always believe this is a way we build relationship, and we carry build the image of the institute across the country beyond our profession. I think that is also a need of the hour. Therefore, I thank all of you. This would not have been possible without the support of all of us, and especially the chairman of the branch and his team, very ably guided by Jaman K. George. We are all, I think, most of the days, we are there till midnight at the branch to see that everything is in place. Even a minor flaw can actually spoil the whole show. But God has been so kind, weather has been, and in fact, I was keeping my fingers crossed because of the Omicron. Anytime anything can happen, even the Vice President of India can cancel his visit, or a lockdown can come. But definitely, it was a great moment for us. Oh, take it. Take it. Fine. Therefore, I would also conclude, because Balakrishnan ji has to. No.
You continue.
Has to continue, catch a flight. Thank you very much.
No, I'm okay.
Careful.
Oh, this is what. I'm sorry, I didn't.
This is
Wouldn't hurt your knee, no?
No.
Fortunately.
I'm all a support guy. Just sorry.
Don't worry.
Sorry. No, you're all support.
Sir, we will ensure that you won't miss the flight, sir. Now, may I request the member in the Professional Development Committee of the Institute of Chartered Accountants of India, P.T. Joy, to present a memento to the distinguished speaker of the evening. Now, once again, I thank you all for this wonderful support. Without you, this conference and the foundation stone ceremony wouldn't have been so glittering. Thank you once again. Thank you very much.
So, thank you. Sorry, I No problem. No.